Thank you for joining us today. My name is Matt Hylland. I'm a financial planner here at Arnold and Mote Wealth Management. And our topic this month is what we see as a potential risk for those that are using the really popular total stock market type of investments that are out there today. And to explore this topic in more detail, we're going to look at the largest mutual fund and ETF out there today. This is Vanguard's Total Stock Market Fund. This comes in both an ETF and a mutual fund. You might hear me reference kind of VTI, that's the ETF version, or VTSAX is the mutual fund version. They invest the exact same way. For our purposes today, they're the exact same thing. And this chart on the left here is just showing the growth of the investments in VTI, the ETF, over time. It now has more than $1.8 trillion invested in this fund. If you add in the assets of the mutual fund, also there's more than $2.2 trillion in this investment strategy. These are incredibly popular investments and have really grown rapidly. And very rightly so. My point today is not that these are bad investments by any means. Vanguard's Total Stock Market Fund is one of the cheapest ways to get access to the US stock market. My point today is going to focus on what is almost a hidden danger when relying on this fund or similar funds as your only equity holding. This has become a really popular strategy for many investors, and you can tell, of course, by the amount of assets in the fund. You'll also see tons of blog and YouTube content out there on these funds, and it's one of the cornerstones of like the Boglehead or kind of Vanguard low-cost investing investment philosophy. But even Vanguard itself sort of suggests that this can be a standalone option. Shown on the right here is a screenshot from Vanguard website for the product summary of the mutual fund, VTSAX. And I highlight that last sentence here where even Vanguard kind of comes out and says, this could be your only domestic stock fund. So what could possibly be so bad or, potentially dangerous about using this fund? The the important thing to realize is that the makeup of the stock market is dramatically changing, especially since this fund is launched in 1992. In case you don't know, these total stock market funds are just purely market cap weighted, which means that the largest holdings are generally going to be the largest companies, and they're getting the largest weighting in the fund. Um, and what has been changing in the stock market, especially over the last decade or so, is that the largest companies have grown so large that they dominate these market cap weighted indexes. And so shown here on the left is just a chart showing how the weight of the top 10 companies in the S&P 500 have changed over the last 30 years or so. At the end of 2025, the largest 10 companies made up a little more than 40% of the S&P 500. And that means if you invested $1 million into the S&P 500, about $410,000 is invested in the first 10 companies. Because the Vanguard Total Stock Market Fund does not follow the S&P 500, but instead a much broader index, it does not quite have 40% weight in the top 10 holdings, but it's still pretty close. The table on the right here is showing the weightings of the top 10 holdings for the Vanguard Total Stock Market Fund, and you can see the top 10 holdings are about 35% of the fund. I think it's safe to say still pretty concentrated. And the one takeaway you should have here is that these total stock market funds are just very, very heavily weighted into large cap companies today, especially. And when you look at the performance of the Vanguard Total Stock Market Fund, it has performed nearly identically to a fund that invests only in large cap stocks. So shown here is a chart of annual performance of VTI, that's the Vanguard Total Stock Market Fund, which is in blue here, compared to Vanguard's large cap ETF, which has the ticker symbol VV and is orange in the chart. And what we're trying to make obvious here is that there's not much difference in the performance of these two funds. For an investor who thinks the total stock market fund is giving them a different or much more diversified investment than a simple large cap fund, this might be a surprise. And now I want to look at that same data, but just chart the differences in the performance between those two funds. And so I know this chart to start here is a little bit hard to read. That's a little bit the point. And then we're going to add some data to this in a minute to help make this point a little more clear. All this chart is showing is the difference between Vanguard's total stock market fund and Vanguard's large cap fund year by year. And so just for example, in 2025, Vanguard's large cap fund outperformed the Vanguard total stock market fund by about 1%. And so you see a 1% or negative 1% kind of data entry here in the chart. And as you can see, the performance really has not been much more than plus or minus 1% over the last 15 years or so. But now let's add a different type of investment. Here I've added data to show the performance difference between Vanguard's total stock market fund and Vanguard's large cap value ETF. So this is the fund with ticker symbol VTV. And right away, it should jump out to you that this new fund, even though it still also invests in many large cap stocks, but because it's focused on value companies, you can get a very different performance, and the fund can act very differently than the total stock market fund, especially recently. And so larger bars here are really just showing you that there can be a bigger potential differences in performance. And so, for example, in 2020, the large cap value outperformed by nearly 20% is kind of how you can read this chart. And we can keep adding other investments to this to show how different types of investments can perform differently and the magnitude of that difference. And so now I'm adding Vanguard's total stock market fund and comparing it to Vanguard's small cap fund. So this is ticker symbol VB, and this is now red in the chart here. And again, what I'm just trying to help visualize is the extent that these other investments perform differently than the total stock market fund or a large cap fund. The whole idea behind diversification is owning investments that can perform differently, but still have good long-term returns, of course, and that have maybe different types of risks associated with them. They do better or worse at different times. And what I want to start becoming apparent here is that the total stock market fund is just so heavily allocated to large cap companies that it will essentially just perform like a large cap fund. And in years where these other types of investments, such as small cap or large cap value, perform differently, you really won't see that much of a change because they're not a big holding in a total stock market fund. And just to keep kind of building on this here, another fund to compare, now I've added Vanguard's small cap value fund to the chart as well. So now that's in blue. That fund has a ticker symbol VBR. And as you would expect, this type of investment can also perform very differently compared to Vanguard's total stock market fund. On average, there's about a 10% difference in performance between the two in any given year. The total stock market fund has all of these investments within it. Again, the problem is just that they are a small enough allocation anymore that these performance differences just really do not cause much change in from how large cap companies perform. And one more chart here just to show, I'm now adding international stocks and emerging market stocks, so you can see another important type of investment related to US large cap stocks here. And this is a little bit of a leap. Vanguard does not explicitly say that Vanguard Total Stock Market Fund should replace international equities. There are a lot of kind of individual investors that are out there doing that, some very notable ones. And especially recently because international stocks have kind of had a poor performance in the most recent couple of years. And so a lot of investors have kind of swapped out or dramatically reduced international exposure. And as you can see from the chart here, international and emerging markets have some of the most significant performance differences from Vanguard's total stock market fund. There's really a lot of good potential diversification benefits in these funds, and really important to not think that a total stock market fund can replace exposure or the diversification benefits into any of these different types of investments. And the charts we were just looking at went back 15 years or so. I wanted to include one more data point here just so you can see another example of potential benefits of diversification outside of a total stock market fund. So here I'm picking kind of the tech bubble just because there's a lot of concern today that the big tech companies that have grown and become huge parts of the market are overvalued, and that investors are, at a risk of a similar type of drawdown that we saw in the tech bubble. Of course, no one knows, but that's what people are worried about and want to know how to protect their portfolio from. And so here's a table showing how different investments performed over a period within the dot-com bubble. And so really the timing of this is kind of an investor who got in about a year before the peak of the bubble, right? So as things were going up, they get excited, kind of put a bunch of money in the stock market. They see it go up for about a year, then ride the decline down for a couple. And by 2003, general market had started to come back to where it was in 1999 or so. And so the top row here in the table is that large cap type of investments, how it performed over this period. And the growth or loss that you would have seen on $100,000 between 1999 and 2003, max drawdown, just to give you a sense of the volatility there. And what you see is that the total stock market type of investment performed very similarly to the large cap funds at the time. A little bit better, just because there's a few percents that's allocated to some investments that did well, but by and large, an investment in the total stock market fund performed very, very similarly to large cap. And then below, you can see some of those other types of investments, that how they performed compared to the total stock market. And you can see there was tremendous benefit to having some additional exposure to these types of investments. Small cap, international, all averaged very, very high annualized returns over this period as the tech bubble was kind of collapsing. Just as the extreme there, international small cap stocks, you saw your money almost double in this period as the kind of tech bubble was popping there. And so just another way I kind of wanted to show how, especially in times of panic, I guess, or just a lot of action in the stock market, that's when these different types of investments can really shine. And I want to be sure to be clear here that overweighting or kind of using these other types of investments can still be done at a very, very low cost with very good index funds. This is not a pitch for active management of any kind, saying that you're going to time the stock market. All it is looking at the benefit of overweighting some of these other types of investments from where you're allocated with a total stock market fund. And so, I put here just some, these are Vanguard tickers for the specific Vanguard funds in case you want to look at them in more detail, the costs that they have. So you see very, very low costs here, the average annual return over the last decade, and then the longest term data that I could find for these, so you get a sense of how these investments have performed in the long run. Big takeaway here is just that these types of investments have a history of performing very, very well in the long run. And so what does it look like if you start to kind of tilt your allocation a little bit outside of that total stock market fund? So over the next couple slides, I just want to show how investment 100% in the total stock market fund would compare to this allocation on the right. This comes from a little bit of research from like DFA or dimensional fund advisors on how to take advantage of some of the different factors and premiums that have existed for different types of investments here. Of course, this is just an example and should give you an idea of how using these different funds rather than just a total stock market fund can let you create a portfolio that gives you the diversification benefits that you want. But here, just so you can see what numbers are being used here, this is a breakdown for a sample portfolio that we're going to look at here. And the first thing to notice is that this is going to put a lot more money into other parts of the stock market, mostly small cap stocks. So this is something called a style box that kind of shows how your investments within a certain fund or portfolio are allocated. And so on the left here, we're looking at Vanguard's total stock market fund and the amount of assets that are either in large companies, mid companies, or small companies. And so just for example, how you read this chart is that if you want to know how much investments in Vanguard's total stock market fund are in small cap, you can add up kind of this bottom row here. And so you're getting 9% or so of your assets in small cap. If you want to know how much is in large cap growth, you're getting about 17% of your money in Vanguard total stock market fund is in large cap growth. And first thing that should jump out to you, again, that very heavy weighting towards large cap stocks. And by taking advantage of a little extra allocation to other types of funds, we can push some of those assets from large cap into other types of investments that we know have diversification benefits from large cap companies. So primarily here we're doing small cap value type of stocks here to get investments that can perform differently than large cap. And then another way of just kind of looking at this diversification benefits is going back to those top 10 holdings and looking at how this is reducing concentration in your investments. And so on the left here is that same table that we looked at before, top 10 holdings of Vanguard Total Stock Market Fund. Again, those top 10 funds are about 35% of your assets. Those big holdings are 5 or 6%. And then here on the right, we're looking at the same table here, but now using those 7 different funds that we have in the allocation that we showed, we're bringing down the exposure to those very big companies. So instead of 5 or 6% in an individual company, we're down to 1.5 or 2. And the top 10 holdings are now only 11% or so of your total investment. We're getting a lot more diversification across the market. We're removing some exposure from how these big companies can control how your portfolio as a whole performs. And so I guess maybe I should just say, so hopefully you kind of see the benefit in doing this here. This is not a call that Apple stock will outperform or underperform. This is purely from a diversification benefit here. We're reducing your exposure, having a majority of your assets in just a few small companies, spreading that around further for essentially no added cost and very little, just a few extra funds in your portfolio. And this also kind of exists in the bond market too. So what's also very popular is these total bond market funds. Vanguard's here. The mutual fund is VBTLX. Again, just showing the product description from Vanguard here. The idea of these funds is that they can very easily be a low-cost way to access the total bond market. Again, a very important holding to have. Not saying they're bad, but I'm saying that if all of your money is in this type of bond fund, there are risks out there that you should be aware of. Those became very clear in 2022 when inflation hit, and a lot of people saw these types of bond funds dramatically fall. And so here on the left, you kind of see a chart of how this Vanguard fund did over that period, losing somewhere, at a max close to 20 or 25%, which was a big wake-up call for a lot of investors who have seen this fund be very stable for many decades and then see this kind of dramatic volatility there. And the reason for this is not so much concentration like it was on the stock market side. It's more of a maturity or duration of bonds. These funds can hold a good amount of very long-term bonds. And whenever you hold long-term bonds, you're subject to very significant interest rate risks. And so when interest rates increase, these funds can dramatically decline in value. That's okay if it's a long-term holding. It's not good though if this is where you want, if you're withdrawing from your portfolio, need a good chunk of money, and now you see that declining 20 or 25%. And so, very much like on the stock side, we showed a few different funds that are available. Here, I'm showing that same Vanguard fund, but comparing it to a couple different fixed income options that investors have and should be using as part of their bond allocation, especially if they're withdrawing or just have potential need for cash in the portfolio. Short-term treasuries, again, because we're reducing the duration of bonds, much less volatile, become a much safer kind of store of value there. Of course, money market funds have an incredible history of keeping their value there even in the worst of times. And just want to use this to highlight why other bond holdings could be very valuable to investors. This type of risk that we've seen here in a total bond fund is not good if that's your only bond fund and you have need for this money in the near term. And so, in summary, thanks so much. Hope this helped just kind of clear up why we recommend investing the way that we do and some potential benefits that we see in allocating specifically to other investments outside of the total stock market fund. Total stock market fund can certainly be a core holding for you, but I think it's becoming very important to have more holdings other than that. And so really what you just want to know is, are you comfortable with, if you are using something like the Vanguard Total Stock Market Fund exclusively for your equity exposure? Are you comfortable essentially just knowing you're invested in large cap stocks? How that fund's going to perform is essentially how a large cap stock fund performs. And one comment that we get, that we've heard recently is why our portfolios are more complex, right? And I don't think you should think of adding funds as more complexity. It's especially today when you can use very low cost index funds. There's software to very easily manage, an allocation between funds like this. Really what you're giving yourself is more control over how your portfolio can perform. You're reducing some risk of, very high exposure to large cap stocks, and that's incredibly valuable, especially as you enter in retirement, to be more diversified here. And I didn't really get into it, but there's a lot of added value in using a portfolio that kind of specifically allocates to these different types of investments for taxable accounts. So this is brokerage accounts, outside of your IRAs or Roth IRAs. This is for added like tax loss harvesting. Also just kind of easier to keep your portfolio in balance. And if you're taking withdrawals, if you're in retirement or just needing money from your accounts, this is also going to be very valuable, especially on the fixed income side, just to reduce that interest rate risk that you have in there and make sure that there's a part of kind of a pot of money that you have that's very stable in your accounts. So thank you again. Thanks for joining us today. We'll be around here for questions. If you have any, please reach out over email, call the office if something here kind of struck a chord you'd like to talk with more. If not, happy Friday. Have a great weekend and look forward to seeing you guys next month. Thank you.